Hello and welcome to Financial Express. We have with us Tianyin Cheng, Senior Director, Strategy Indices, S&P Dow Jones Indices. We are discussing if factor investing can give you higher returns consistently over long periods. If yes, then should you invest in it? If not, then why should you invest in it? Welcome, Tianyin.
Thank you for having me.
First question, directly. Can factor investing give you higher returns consistently over a long period of time?
Well, I mean, I would say yes, but I would also define, factor in, usually outperform, the broad market over a long period of time. And this is according to many academic research as well as empirical results. So factor definitely is not a new concept. Things like value, quality, they have long existed for many years, part of the stock selection framework for active managers. So, active managers, they really, have been using factors for decades. What sort of has been new is the growing recognition that investors can access this source of returns in a passive manner. So in a way, this is the evolution we see that, what is called smart beta. Essentially, this is the best of beta and alpha combined together. So talking about performance, definitely, I think, one thing I want to mention that is factor outperform over long run. So if you look at some of the indices that we have launched, S&P BSE factor indices, the 4 single factors, value, quality, momentum, and low vol, they outperform the Sensex 30, right, over a long period of time, so 15 years. However, there are cycles. Value, for example, it has long underperformed until like mid of last year, where you see, the market has changed in the trend to become a more value-driven market because it's in a recovery phase. And value really performed well. This year, it has already delivered 55% year to date, whereas you compare to the broad market is like 20% or slightly above that. So I think the implication for investor is if you are thinking about factors, number one is if you are holding on to single factors, you want to hold down for a longer period of time. You want to set expectation that those strategies may underperform for a significant period of time, but overall they do outperform. And I think the other thing that investors need to understand is different factors have different characteristics. We mentioned that they all outperform, but they outperform in different ways, right? So low vol, for example, they tend to have a beta less than 1 compared to the market, meaning when the market is up, is not up as much as the market, but when the market's down, it provides you sort of a protection. And therefore, the outperformance you should really look at from a risk-adjusted point of view. So low vol would give you sort of a steady performance, and they tend to outperform in terms of like a Sharpe ratio. It can be a bit challenging if you look at absolute return.
Okay, then other than returns, what is the case for investing in factors then? If let's say there are significant period of drawdowns when investors might get nervous about holding on to such investments.
Yeah, I think this is a very good question. The use case for factor is usually from a return point of view that we have discussed, but it's also can be from a risk management point of view. For investors who have already allocated to core equities, they can consider investing a part of their portfolio into, satellite, all right, strategies. It can be factor, it can be thematic, anything that is slightly different from the core allocation that can give you a bit of potential of outperforming or delivering the alpha. And you want to balance, how much you want to pay for those strategy versus pure broad market indices as well. So definitely one example is when people are setting up core satellite portfolio, low vol can be a good option because essentially low vol has lower volatility compared to the broad market. So you can, let's say, take 10% out of your capital into low vol, but low vol will only, give you maybe 5% of your risk budget. So if you're looking from a risk budgeting point of view, maybe for that 10% capital, you can only put 5% into low vol and the other 5% into more, alternative asset, more risky assets such as commodity that might give you a better return or better inflation protection in certain market environment.
A 10% or 5% satellite portfolio, satellite allocation. I'm just wondering how much of needle can that move or can prevent needle from moving during drawdowns. Please.
Yeah, I mean, definitely this is a good question. So I'm more speaking from an institutional investor point of view, where they have sort of a large capital, and therefore the objective is really not to move the needle, but to make the portfolio more resilient to different market conditions. I mean, if we are talking about retail investors, I think Factor is a fantastic tool for you to express your market view. Let's say you kind of feel the market is going up. However, because interest rate might be increasing, tapering is coming, there is a bit of fear among investors. You want to protect your portfolio, but at the same time, market continues to go up. You don't want to miss that. So instead of investing into, let's say, the core equity, maybe you want to switch into something more defensive, maybe a quality strategy that tend to perform better when market is still going down, because those quality companies, they are usually stronger in balance sheets and they tend to support their stock prices through buybacks, right? So, even when market is not doing that great, they can still deliver sort of a certain extent of performance. So from a retail investor point of view, I think that is definitely one way for you to implement.
Actually, if you can talk about specific factors, which are the factors that behave or that fall down more than the index during drawdowns? Which are the kind of factors?
Yes. So in S&P, we publish research on factors. So my colleague Akash from the R&D team has a very good research paper on factor performance during different market conditions. I think we kind of break the markets into the bull market, the bear market, and the recovery phases. And we find that value is the factor that tend to do well during recovery phase, and low vol and quality are the factors that tend to do better when the market is not doing well. So in this sort of bear market, and then when the market is sort of doing really well, then it's momentum factor that you should look at, because these are usually companies are doing really well in the market, and you want to ride on those momentum and continue to outperform the market.
What phase do you think we are in right now? Which factor to invest in right now for next 5 years?
I mean, it's very difficult for me to say that because, as an index provider, we don't really sort of give advice or like a market view. I mean, I think it's, it's also very challenging to predict what's going to come. So to maintain a very diversified approach could be sort of more conservative way to see things. And therefore, I want to bring out the concept of multi-factor. So when we have single factors, what we see in the US market is very often that the product issuers, they launch single factor products, and then they work with strategists or financial advisors to give advice to the end user how they should combine these single factors by using the building blocks available. Like ETFs is very easy to trade, so you can easily modify your allocation among different factors according to the views or according to the best asset allocation strategy.
On the point of diversification of portfolio, again from the retail point of retail investors point of view, is it advisable to build an entire investment portfolio using only factor funds?
Yes, I would think so. I would think so. If we look at different factors combined together, I mean, simply look at all the S&P BSE factor indices, I would say it covers maybe 100 names, altogether. So it is pretty much the large and mid cap universe of the Indian market. But the weighting is sort of different compared to what we see in the market cap weight indices. The reason they are different is because the rating are driven by the factor definition, right? So the how different factors are performing, and therefore in a way you are putting some of the fundamental views or technical views already into your portfolio. In a way, you outsource some of the fundamental analysis or technical analysis to the factor strategies. And then you only need to worry about, the market view itself. And according to the market view, you can adjust your factor portfolio. I can take one simple example, right? So let's say, we don't have a view right now. One easy approach is to take, the most famous factors, the four I talked about, maybe plus small size, equal weight, for example, and we combine them in an equally weighted portfolio. So you have 20% weighting on each of these factors. This kind of strategy is better compared to allocating your 100% asset into a single strategy from a long-term risk return point of view. And the reason is very simple, because the different factors, they have very low pairwise correlation. So they don't behave the same. And we understand diversification, right? So when things have low correlation and you combine them together, you get something that is sort of a lower volatility, but you kind of get an average return, right, in between of the different factors. So with that very simple concept, because we have different building blocks, like 6 of them, you can use very simple principles. Markowitz, minimum variance, for example, this kind of simple principle to construct your portfolio, right? Equal weight is one that I've given an example to. Yes. And minimum variance is another. You can think about trying to maximize the Sharpe ratio by combining like 4 or 5 single factors. That's another one. And then you can overlay with your own fundamental macroeconomic views, to further adjust that allocation.
The 4 famous or popular factors that you spoke about were momentum, value, volume.
Yeah, so typically people look at value, momentum, quality, low vol, and size.
Okay. When we talk about these different factors, how do indices makers such as yourself calculate where does value come from? So, for example, if there is an index of 100 stocks and you have to select 30 value stocks from that, how do those 30 stocks are selected?
Yes, we will start from a parent universe. I don't know, BSE large mid cap, and for each security in that universe, we would look at their fundamental. For value, as an example, we look at price to earnings, price to book, and price to sales. These 3 matrices, which are like commonly accepted as the value matrices. We give each company sort of a score. So the high, the better performing companies in terms of valuation gets a higher score. And then, then there's an equal weighting to, approach applied to combine, PE, PB, and P sales to get a composite score. And then from there, we select maybe 30 companies as a narrow basket, which are the highest scored companies in terms of the composite value score. And then you can combine them, give them some weight. Usually, approaches is either equal weight or market cap weight. But if you want to sort of more tilting towards a value factor, you can even do a score weighting. For the case of S&P, we actually combine score with market cap. So use the product of value score and market cap to be the weighting. It can be very difficult for someone to understand when they hear this for the first time. But essentially, if a company is larger in market cap, it gets more weight. And if it's also cheaper in terms of PE, PBP sales, they get some larger weight as well. So your portfolio overweight those cheaper companies in the typical value strategy. Similarly, you can have momentum strategy or quality strategy constructed in a similar way. But just to add on, because people may not be familiar with quality, usually we look at ROE, which is a very famous profitability and quality factor. But we also should look at the earnings quality, right? So it's maybe their ROE are good, but the balance sheet is not that healthy, right? Although the company display good ROE, so therefore we usually look at variations of earnings over the years, how stable they are, right? And we typically also look at leverage as an sort of additional factor to understand, how companies are doing, potentially in downturn when leverage become more important.
Is the selection dynamic as the market goes forward and as the underlying metrics change? Does the composition also change?
Yes, they are. In the active words, people can adjust this portfolio on a daily basis. But for passive, from an index point of view, we typically do the rebalance on a semi-annual basis. For value, for example, you don't get new sort of financial reports on the daily basis, so it makes sense to do it less often, so that we don't generate a lot of turnovers, and it's also very important from an issuer point of view, because they want to be able to trade and track the indices so that they can offer like a sort of a relatively cheap product than active products, right, to the end investor. So that's, I think the idea of doing this dynamic rebalance on a semi-annual basis. You don't want to do it too less, you don't want to do it only like once a year or maybe twice a year. That is just a bit far away from the market movement, and therefore it's a bit of balance.
At the beginning of this conversation, you said that it's only over the long term that factor investing actually helps in generating alpha. I would like to get back to that. How long period are we talking about?
Yeah, so definitely the idea is, factor have cycles, so they have ups and downs. I can give you some sort of numbers here.
Please. Yes.
Yeah, so if we are looking at the S&P BSE factors, right, how they perform compared to the Sensex index. I'm looking at 10 years, right? So over the past 10 years, BSE Sensex returned 15%, and this is price return and including dividends, right? So total return. And quality, they returned 18%, and then momentum is 19.9%, and low vol is 18.4%. Value is slightly less, so slightly underperform Sensex a little bit. But if you look at value's performance year to date, as I mentioned, is 55%. So 30% outperformance just within 11 months period.
11 months.
Yeah. So that's sort of the cycle I'm saying, for the past 10 years, value has not been outperforming. But over the past 11 months, it outperformed 30%. And this is, sort of a characteristics of value. It tends to rebound really fast. But then the cycle, and then the down cycle could take a long time, say 10, 11, 12 years. Value, if you look at global value, right, US value hasn't been delivering performance over the past 12 years. And this is the longest ever underperforming cycle for value so far.
Investors will be very, very disappointed if their one of the favorite factors was underperforming continuously for 10 or 12 years. They will never know if it's the right time to pull out the money from it. But in your estimate, coming back to BSE value, you said 55% versus BSE's 20%. 25%
yes.
outperformance. So this year's outperformance in value over Sensex, do you think that will make up for the last 10 years underperformance?
Yeah, it's close, not yet, but it's almost, we're getting to the watermark. Yeah, please go on.
Okay, so if I understand this correctly, what do we tell our audience that if you're investing in factors, be invested at least for 10 years or 15 years or 20 years if you want to see significant alpha? What's that number?
Yes, I think generally, we're looking at 10 years, but this is not realistic, for many of the retail investors. So there are two approaches I would very often talk about when it's retail investor. One is you do a strategic allocation using multi-factor approach. Do not choose a single factor because you never know how long it takes your single factor to rebound back.
Yes.
Yeah.
Yes.
So do use multi-factor, and if this is your strategic allocation, consider multi-factors. And then you can also think about timing factors. So that is the tactical allocation, right? So for that, you got to have a bit of a view, right? So it cannot, you have to pick and choose which factor you like. Sometimes it's easier, sometimes it's harder, right? So when market's going down, you don't want to lose money, so you can, either get out of the market or you allocate to some less aggressive strategy like low vol or quality. Just in case the market may rebound, you're still fully invested, right? So that's one thing. So that is a tactical decision example that you will need to make if you're using single factors.
Sure, but that would happen at the investor end and not at the AMC or indices end, right?
That's right. At index end, we also, S&P also have sort of factor timing solutions. We have a factor rotation strategy. Essentially, the strategy was built on the idea that I talk about on the research paper. Different factors tend to behave differently in different market cycles. So that strategy will look at the macroeconomic signals from the Fed, whether the U.S. business is in contraction or expansion, and then we decide. We kind of break every economic business cycle into 4 different phases. Try to decide which phase we are in by looking at the data, and then allocate to one and only one factor each time, and then rotate according to the data. So that strategy, is a typical factor timing strategy, and is very sort of aggressive in my view. It has a generally higher volatility compared to like strategic multi-factor allocation or even like single factor, which is already high in volatility.
Do you get the timing factor right every time?
No, it's very difficult. People have to realize it's very difficult to predict market cycle And even you have the market cycle correct, you may not know which factor gonna outperform, because it's sort of a general rule rather than it is something that happens every time. So generally we think that small cap and value outperform in recovery, but they may not, right? They may stop behaving that way. So I think it's a bit of a challenge. Therefore, even among institutional investors, the factor timing is not something that they used very aggressively. They use that for a certain extent. And this is already built on their extensive understanding of the market and the research. Yeah.
And moreover, timing the market would also result in some bit of churn as well in your portfolio, and tax implications as well, depending on the different geographies and tax rules.
Certainly, so when we talk about factors, I mean, it depends on how you view the market, right? Typically, I think for any investor, they have a domestic bias and they view the rest of the world as a whole, or maybe they view there's US and Europe. But it's kind of not realistic for retail investor to have all different geography consideration and allocation. So I would say that do what you're comfortable with. So if you are comfortable with what's going on in India, then that's good, because you can have a bit of more confidence when you are putting, let's say, more allocation to certain factors. You know why you're doing that. Similarly, US is a very big market, so everyone can do a lot of US, because there's a lot of research out there for you to read through and to get advice from your financial advice as well.
US investing is a whole other topic, and I would love to have another discussion with you some other day on that.
Sure.
Coming back to India, fine, we have talked about factor indices, there being indices available. How to invest in those? Are there enough vehicles available?
Yeah, that's a very good point. I think in S&P, we launched the BSE factor indices in 2015. And I think at the time, we were a bit ahead of the curve. Factor has been a big thing globally, in the US, maybe 5-7 years ago. But over the past couple of years, the new launches has dramatically decreased because the market is essentially quite mature and saturated. Differently, in India, there hasn't been a lot of product launches, because I think a lot of the product are still being focusing on sort of a broad market, and even the sizes and then the sectors. So that's a natural progression that we see in every market. Once people have those tools, they will start to look beyond, and factor tend to be the next thing. And sometimes people also look at thematics, which is pretty hot this year. So these are all sort of tools that product issuers try to launch, make available to investors so that they can use, they can trade. So make a whole lot of a sense from our point of view to see such kind of products coming out. So we are also working with one product issuer to roll out a suite of BSE factors so that investor can access this kind of a more nuanced, niched building blocks in a convenient way, in the ETF format, in a cost-efficient way.
Which issuer set and what factors are we talking about?
I think we're talking about a suite, so like a whole family of different factors.
And by when can we see the product rolled
out? Can't really speak from an issuer's
sure.
Point of view, but yeah, sure. I hope it's gonna come out. These products gonna come out very soon, and I'm very excited about it.
Tianyin, if you can very briefly touch about the issue of liquidity while investing in ETFs, be those factor investing ETFs or headline indices ETFs in India particularly. Even on the headline indices ETFs, the assets under management are pretty small, and when it comes to factors, those funds are really very small. So how does one navigate the liquidity and the pricing difference arising out of that?
I think for end investors, ETF liquidity is what they see on the screen, right? When they buy and sell, they see the orders comes in, you see that liquidity and you see that spread. But I think it is very important for everyone to understand the ETF liquidity is exactly the same as the liquidity of the underlying, right? Because ETF is not a fixed number of units. Units can be created, and the market maker facilitate that. So that's the logic, and therefore, as long as market maker can, buy the underlying basket of stocks, they can create the ETF. Therefore, the liquidity is a lot deeper compared to what you see on the screen. And even for like institutional investor, they want to access the ETF in a very high amount. It is definitely executable. I mean, that, according to my knowledge, right? But it may not be that liquidity you see on the screen. Sure. From an issuer point of view, definitely the turnover, the sort of index liquidity is one important factor to consider, because that eats into the operational cost, and eventually that becomes the total expense ratio that you see. So yeah, so unfortunately for factors, I mean, liquidity cannot be as high as broad market indices. But when we design the index, we look at these factors as well. How much outperformance you're getting per unit of tracking error you are deviating from the benchmark. So these things, I'm sure, I just want to assure, are considered, and therefore some of the rebalancing schedules or how aggressive you want to be in selection are sort of considerations built into the factor design.
Final thought, Tianyin, the bottom line: if our audience, as suggested by you, create a portfolio of 5 different factors, equal weighted, 20% each or 25% each, and are willing to hold it for next 15 years for maybe their children's future, how much of an alpha over the index can they expect?
From a academic research point of view, I would say, looking at the U.S. market, which I'm more familiar with, I would say if the outperformance is less than 3%, I probably won't consider every year. But one thing people need to realize is, because when more people are doing factors, yes, the factor premium can get compressed as well. If very simple logic, if the place become more and more crowded, it cannot be cheap anymore, right? So that is something people need to realize. Of course, there are some behavior financial reasons behind why certain factors outperform, and that supports 100-year evidence of why momentum outperform, for example. So I think there is a bit of more than just mispricing. Maybe there is like behavior finance reasons. So that would continue support factors. So all in all, I think for Indian market, where factor is still sort of a bit new, I wouldn't worry too much about the factor premium compression, at least for the next 10-20 years.
And we can, as you said, 3% or 300 basis points outperformance over index is what investors can expect to build into their portfolios.
I would say this is like my personal, sure. Logic.
Of course, and I'll add the disclaimer there that no one knows how the markets will behave. These are all just.
Yeah. So it's, if it's less than 3%, I don't think it was the effort, because it does require you monitoring the market, know what's going on, right? So so that's more from a personal effort point of view, like how much opportunity cost. But talking about factor indices, I would also want to emphasize that not every value indices are constructed the same, although they have the same name. They're all called value. They're not constructed the same. So when investors are looking at factor strategies, I think it's very important for them to understand, number one, what is the parent universe, and number two, how aggressive these strategies are, whether it's a narrow strategy or broader strategy, and what is the sort of return and risk expectation. You want to ask these questions to the product issuer, so they can tell you, it's whether it's aggressive or whether it's conservative. So you have a bit of expectation, what is coming in, and therefore you can compare with the cost and make your own judgment.
Tianyin Cheng, thank you very much for being with us. Definitely, there are several takeaways for our audience and for our investors from this conversation.
Thank you very much for having me. Thank you, Charlene. Very nice talking with you.
Thank you.